All righty, Gina. Hold on.
Hi. Ready for me to go?
All right.
I just feel
Hi.
natural.
My
How
name
are
is
you, Gina?
My name is Gina Marinucci, and I'm the owner publisher of Miami Real Producers. It's an extraordinarily successful publication that's nationwide, and we are targeting the top 500 realtors in the respective markets. We're in 108 markets in the United States, and we are currently on the brink of opening up in Miami. So, which needless to say, is one of the funnest and coolest markets in the US.
Woo!
So I will go ahead and introduce our moderator, which is Rebecca Carmona, and she is a fifth generation Miamian with her family settling in Miami in 1905. She has been a realtor for over 16 years and is currently with Keller Williams Capital Realty. Is also the 2020 president of Women's Council of Realtor Miami-Dade, which is also a co-host with us with this power panel. So thank you.
Thank you.
Yeah. George. Hi, George.
How are
Guetta?
you? I'll do it. Guerra. You gotta be able to roll
Guerra.
Guerra.
Okay, Guerra.
Take some practice. So you got it.
All right. Maybe a few cafe con leches, and then I'll get it right. So so George Guetta, raised in the boom and born in the crash. He's also a Miami native, broker, owner of Real Estate Salesforce, and 2020 chairman of the Miami Association of Realtors. He has been featured in many articles over the last 10 years for its innovative video techniques and for the speed of now. Welcome, George.
Thank you. Thank you for having me, Gina.
Yes. Anna Bozovich. Hi, how are you?
Hey, how are you?
Anna is a founder and owner of Analytics Miami. For the past 3 years, she's been publishing long-term trend analysis on the Miami real estate market. Anna studied math and physics at Columbia University, and the Analytics Miami reports draw upon her abilities to see past the noise to recognize pattern in data. Welcome, Anna.
Thank you.
And Christopher Silvera, born and raised in Miami-Dade and is a loan originator with Van Dyke Mortgage. Chris knows what it takes to purchase a home, condo, or commercial space in this unique market and specializes in jumbo loans. Hi, Chris.
Hi, thank you so much for having me.
Thank you. And last but not least, Ashley Kuszak. Hi, Ashley. Is a realtor with 20 years of experience with Berkshire Hathaway Home Services, EWM Realty. She has consistently won numerous awards within her brokerage as a top agent. She is a member of the Master Brokers Forum and is actively involved in several community organizations. And I also know very active with your children.
Yes.
So I'm sure homeschooling has been fun. So welcome, Ashley.
They're older than that. They don't want It's all good.
Cool. So Rebecca.
Thank you so much, Gina, for all those awesome introductions. I'm so happy to be here with these fabulous leaders today. We got some awesome questions to run through. We have audience still joining us as participants join. Guys, everybody that's watching us, there is a Q&A section at the bottom of your screen. So if you have questions for these amazing leaders in our industry, leave the questions there. And towards the end of the session, we're going to get to all those questions and answer them, okay? So let's get started, guys. We're here to talk about COVID-19. I mean, I think it's been on the calendar 450 days by now, right? I mean, I don't know. It seems like forever, this COVID-19 conversation. But I think over time, it's growing and the conversations are changing and realtors and people in the industry are actually experiencing things that we could share amongst each other to help each other grow, right? So the biggest question I have right now, and you know, this is for anybody that wants to answer it, what kind of impact have you experienced right now during COVID-19 shutdowns? Who wants to answer that question? What kind of experience have you had? Ashley, I saw that hand come up.
I'm happy to. I mean, we've seen, a lot of people were hovering right before this all started. We had a lot of people kind of lined up to make offers, and we saw a lot of those people kind of hold back. I think wait to see what's going to happen. But everything that we had lined up has gone through. We were able to keep every deal in, in the pipeline, and they've all closed. There's been a lot of interesting things that are happening, but yet we've still been able to get financed and cash deals closed. So, and in the high end market has been booming. I mean, Gables Estates has had amazing sales. We've had a lot of sales over like, 5 million, 9 million that have taken place since this started. So it's interesting.
That's great. Now, has there been any obstacle at all in any of these deals? Anything you can share with us? Maybe a lesson you learned, some kind of obstacle?
For me, I mean, we definitely have had some obstacles. We've had, on a couple finance deals, they had to push back a little bit because the banks are, overwhelmed and trying to catch up. So that's definitely been an obstacle, and getting people to the table, I feel like, has been an obstacle for us. But it now, like, my calendar went from being very, very open to pretty booked now. So we're kind of seeing that open up a little bit. So hopefully
that's good. Anybody else have anything to add? Anything they've experienced during this COVID-19 shelter in place, obstacle, lessons learned, anything you can share with the community? Well, if you're going to be crickets.
I'm going to let all the ladies go first. So Ashley went. I'm gonna let Anna go next. Anna?
You're such a gentleman. You're such a gentleman.
You know what?
Anna banana.
When there is no order, we put some order here. So Anna, talk to us.
I hear you.
Anna.
On the obstacle lessons learned part, I think that in general, periods of change like this are great times for self-reflection and to get clarity in how you want to proceed. I've personally enjoyed a little bit of the silence, we'll call it, right? There's less hectic, less day-to-day life. People are going out less, all those things. And when you have a little bit of silence around you, I think that if you take advantage of that time, it's a great time to get clarity and sort of the silence in your mind where you can focus on what you want to do and how you want to move forward. And I think that's actually been one of the most positive sort of side effects of this time period that I've enjoyed. Periods of self-reflection, clarity, and the space to sort of create how you want to move forward past this. Because I think it's very important to point out that there's no on button. Like people use the word pause to describe this, and that really irritates me, because a pause is when you're watching Netflix and you pause and you go back, you get your drink and you come back and the movie starts where it was, right? Pauses don't exist in real systems. It's like, can you pause from working out? You come back in a month, you're out of shape. It doesn't work that way. It's the same way with the economy and with business. There is no such thing as a pause. And so when you have, nationwide unemployment's going to hit 25%, that's not a joke. There is no on button from that. So I think it's very important that you stay positive. I don't subscribe at all to feeling bad or panicking. You stay positive, but it's very important to recognize there's a fundamental shift in the economy and the way of life that's going to last for a very long time. There is no on button in July or August or anything like that.
So when it comes to impact, I'm a firm believer that we haven't seen the biggest impact yet. That the biggest impact is probably still in front of us. Yeah. From a practicing perspective, the biggest impact has been, really the shift to video. From a meeting perspective, from a training, from a networking, from a prospecting, how we've shifted, to leverage technology that we had in the past and using it today. 2 days ago, I got on a conference call, and in the middle of the conference call, I said, guys, let's put off the phone, let's Zoom. My preference has even changed. My ability to communicate effective has improved due to some of the changes that we've seen, here. The biggest obstacle, quite frankly, the fact that we have to social distance in a business where we're forced to be social. How do you, how do you get your groove on? For those of us that don't lock ourselves in a closet and make 100 phone calls, for those that go out there and they network and they socialize and they work their sphere, I think the biggest challenge has been, finding different ways to do that effectively. Anna was talking about the pause. This lockdown, the world has stopped. I think, God knows what's going to happen. I subscribe to her optimism let's keep it positive, and hopefully, we just snap out of it and come back. I think the greatest obstacles I've seen is, service and the restaurant industry have to change and go more e-commerce. And by far, the hardest obstacle that I personally had to overcome is really 5th grade homework. Boy, I didn't know how hard 5th grade math. Anna, maybe we can barter here. But I'm having to Google and figure things out.
YouTube. You could just YouTube it. YouTube, George.
So to me, those have been really the real impacts and obstacles that I've seen so far on the short run.
Yep. I just want to, you were saying, Jorge was saying that we're still very early in this. The sort of the domino effects hasn't even really begun to trickle out fully. As far as real estate is concerned, April is the first month where we start to see Corona economy numbers. The rest of it was previous pipeline. And so May and June is when we're going to actually start seeing what's happening. And right before this call, I just contributed some data for a Real Deal article that's coming out on Sunny Isles. And just FYI, Sunny Isles $1 million plus was down 77% year over year in the month of April. So the challenges moving forward in our general economy here are going to be unemployment and a whole lot of people being a lot less rich than they were before. And that ends up being like a generational shift in consumption, right? But just to go back to what we were saying, Jorge, on the positive, I think that the positive outcomes of this are the acceleration of trends towards virtualization, and all the technology that we had before, we didn't use it to the extent that we could because we had habits that were in place before. So this has kind of helped push us towards better habits, newer habits, and it's accelerated that virtualization of many things that I think are to our benefit.
No, it's true. I mean, we really are not going to see this impact for some months to come. So, I think the only thing any realtor can do right now is be positive and have some kind of hope that everything's going to be like a V shape and we're going to be right back to normal very soon, hopefully. Nobody really knows, but hope is something that gets the mindset going and keeps the positive. So Chris, we haven't heard from you on the mortgage side. Tell us a little bit about, what are you doing with the mortgage loans? Preparation to close.
Chris, we can't hear him.
Chris, are you there? Oh.
Can you hear me now?
Yes.
Okay, so sorry about that, guys. So from the mortgage standpoint, as a lender, the biggest challenge that I'm experiencing right now for what I consider volume business, the price point between 250 and 350, maybe even 400. A lot of those middle class borrowers are not working because they're not self-employed. They're dependent on a company who has, shut their doors for XYZ amount of time. So employment verification has been a little challenging, even for transactions within the pipeline, because sometimes they're bartenders, they're in hospitality. Actually, when Ashley mentioned that some lenders are pushing back certain contingency periods, she's speaking from experience, because I've had to actually request extensions on certain commitment dates and closing dates because of these delays in getting verifications of employment or additional documents from a CPA who may have, closed their doors until further notice. I have self-employed borrowers who are waiting to get their taxes filed, but the CPA is not responding. As far as appraisals, that's also something else that's always a big question, is how appraisals have been affected. From the lender standpoint, we are being a little lenient. I just haven't seen any leniency needed in terms of sellers are being okay with being precautious and taking that necessary step to disinfect their home after an appraiser comes in. They're not necessarily refusing entrance to the property. The only time we'll need to, look into an alternative like a drive-by appraisal or exterior only appraisal is if they were refused entry to the property. But as of right now, I guess part of the struggle is putting these precautionary measures in place, which we're not used to, in order to conduct the appraisal properly. As far as lenders, I mean, the jumbo market is moving, but we're very limited to how much money and what kind of outlets we have in terms of jumbo lenders right now. Because a lot of lenders have suspended their jumbo products. I haven't. So I'm able to still offer jumbo options, although they are a little bit more stringent. It's 40% down, unless you have a property that you can cross-collateralize, situations like that. And you're also going to be required to have a little bit of a higher interest rate with the option that I have available at the moment. But buyers in the high-end market aren't that sensitive to those things. So it's not necessarily a major challenge on that end. But if you're looking at $800,000 or $900,000 houses, that's where we're going to see a little challenge when it comes to the jumbo market, but not 1 million plus at least. But overall, I mean, I'm still thriving. I agree with George. This transition to video calls has been extremely challenging, although I'm getting used to it. And I think that overall, we're all gonna, continue to thrive and get out of this together.
Awesome. Ashley, the luxury market, what is your personal outlook on that? I mean, do you think that it's, we're hearing here that, middle class and the, people are losing their jobs. We have a huge unemployment. Do you think that's going to affect the luxury business? Have you seen anything happen?
I mean, it's definitely going to affect us across the board everywhere, except that I would say the luxury market is, a lot of these people are actually getting bullish and getting, and getting in if they're, we've seen a lot of activity in that market, which I was surprised by. I didn't expect to see as much as we have. I think that the single family homes are going to be stronger than the condos. I think the condo market's going to feel it more, like you mentioned Sunny Isles, or somebody mentioned Sunny Isles. I think that a lot of people coming from New York that were already thinking about coming, I think this is kind of propelling them to come. And so, we're definitely going to feel this, but I do think that the high-end market we've seen so much movement, and there are like 5 houses over 9 million that have been put under contract since this started, which I thought was really interesting. I wouldn't have expected that, but so.
Very true. Anna, where do you think we will see opportunity open up? You're analytical. You know it best, Anna Banana. Where is the opportunity? Where can realtors make money?
Where do realtors make money? On transactions, which is why when I speak to realtors, I always speak about transaction volume. That is the driving engine of everything. And transaction volume has, and any price points beyond local support has been dropping since 2013. So I would say for realtors, it is super important to be aware of this and to figure out how to differentiate yourself and add value. As an example, Miami Beach finished Q1 40% below transaction volume of 2013 for condos, and that was before COVID. So it's very, very important for realtors to acknowledge that, and also to recognize the distinction between how products behave that are in-place demand versus destination money demand. The healthiest markets that we have in South Florida are the single-family house markets that cater to the local working population. There's in fact an undersupply of that market, right? So when you have times of crisis like this, when many people feel like less rich, people feel less rich, they pull back, they spend less, right? We see this, cosmetic sales were down 10% like last month, right? So people make fewer discretionary purchases in times of economic uncertainty. So I would tell realtors to spend your time on buyers and sellers who need to transact. You want to find people who need to transact. The people who are just looking, they're not going to feel pressure. Unless like you have, or they might be the ones who are going to pull back because they feel economic uncertainty. So look for people who need to sell, who need to buy, and focus your energies there. But and on the segments of the market that will fare better in a downturn, which in my mind is going to be in-place demand. I think that luxury is going to get hit because our luxury market relies very heavily on destination money. And this is a global event, and people are traveling less. It took New York hotels 2 years to recover post 9/11. Right? And that was in terms of, occupancy, ADR, all that stuff. And that was an event in one city. And so now we have a global event, and all the people who are moving and putting money here, they're going to come less. And so I would focus on in-place demand and on figuring out how to differentiate yourself and deliver value, because transaction volume has been dropping and will continue. It dropped a lot. April transaction volume dropped hugely across the board, and it will continue to do so. So this is the time to really focus on yourself, like I was saying, and figure out how to differentiate yourself and add value to the market.
That's great. That's really good information. I find that valuable myself as a realtor. George,
Okay.
new listings, new pendings. What have you seen change? What, you know, have you seen any changes from a Miami Realtor Board?
So you know what? There's obviously been a slowdown that goes without question. But we are an essential business. People are still moving. You know, we're an international city. We haven't stopped. You know, very similar to what Ashley was saying. You know, even the big properties are still moving, adding great confidence to our market where there's confidence.
No, absolutely. I agree with you. So we have a question here that I actually, since we're talking about pricing, Anna, let's just answer it now. For the people who need to sell or have already moved or need to move, will you see a shift in lower prices for people who really want or need to sell?
Yeah, absolutely. Prices follow transaction volume. They follow demand. In an environment of dropping transaction volume, you have to be very attractively priced to get that customer because there are fewer of them. It's just simple supply and demand. That's going to be more true for condos than for single family homes because condos are more commoditized. They didn't specify which it was. But for condos, absolutely. Like you already had buildings with 20, 30 listings and not that many sales in the last few months. So now that's going to be really imperative there. For single family, also look at your neighborhood, see what's been selling, and you really have to price effectively. If you have to move, you're going to have to price very, very effectively. And then there's also the thesis of how does this look moving out? Look, again, I was going to say the domino effects of this are very big. This is not going to be like August, the economy is back to booming. Like we're in the United States is a service economy. 47% of our GDP is related to service-related industries. And those are the ones that are hardest hit by all of this. And South Florida is heavily reliant upon tourism, hospitality, all that stuff, right? So there's no way this bounces back July, August. So if you got to move, you have to be the most attractive price where you are and just exit.
Yeah.
So I take it we're going from the V curve to the L curve? And
no.
There's no V curve, not possible. Guys, like 25% unemployment that's a real thing. People don't realize, like in the Great Depression, economic activity did not drop to zero. It dropped 25, 30%. That's what it takes, right? It's a change of behavior at scale, and it trickles through and it changes the zeitgeist. It changes how people consume things. And that's what we see now, like which stocks are performing well, which, across the economy, it's the same thing in real estate. It's need-based consumption. Need-based consumption is doing okay. And the rest, like people, like there are fewer Google searches for shoes. Like I love shoes and I haven't bought any shoes during this. I'm serious. So all the discretionary stuff has decreased from Google searches to shopping, all those things. It's a reversion back to like a need-based economy. And we're going to see that reflected in housing decisions too.
I also think in the housing market
so when do you think we'll Sorry, go ahead, Ashley. No, we have a little lag here going.
Add on to what Anna was saying, but I think also a lot of people, this is our busiest time, and I'm really talking from the housing market more than I am the condo market. But this is our busiest time, usually February, March, April, that we list houses, right? We sell all of our houses in the spring and the summer and, get ready for people, who are coming for school and everything. And we didn't list any houses in those months. So we've got a pent-up demand that's going, we've got a supply that's about to come on the market. So everybody that I'm talking to, I'm kind of encouraging people to come on aggressively, but come on sooner than later, because in another month, I think all those people that needed to move are going to put their houses on the market, and we're going to see, all what's usually spread out over a few months come like in a month or two, and not have as much of a not much spread out. So I think it's going to be, I don't know, that's my fear, and that's what I'm kind of preparing people for. But I think right now we've actually seen some houses sell because I have more time right now to look at every single house that comes on the market. And the buyers who are real, like you were talking, Anna, the people that need to buy and need to move are doing it. And they only have so much choice because in the housing market, at least, there just hasn't that much new that came on. So when you came on, you got attention. And so
I agree. And also, like, as we know, we've redefined public space and all these things. I do see a general increase in preference for single family over condo moving forward. and then single family was doing better than condo to begin with. So yeah, I'm agreeing with you. There is a fundamental need for that product. Yeah.
Anna, distressed properties. When do you think we'll see some properties that fall into distress? What is your prediction?
Yeah, so like I was saying, April is really our first month where we're starting to see COVID economy numbers because the pipeline from before has to run out, right? So I think that May, the non-payments in May across residential and commercial are going to be the next reality check. And then I think that come June, we're going to have like the real reality check. And I see around that time period, we're going to start to see, because if around that time period, we still stay at these low levels of transaction volume, like we're seeing in April, I think that at that point, people are going to readjust. But having said that, again, it's going to play out differently across, better or worse, across subsections of the market. But just as an example here, like on the beach, like we already had luxury condos trading below 2013 price per square foot before Corona. For instance, at the Marana Grande, the Icon, whatever it is, that demand had been dropping. But having said all that, in general, I see like summer, June, because I don't, personally, I'm not predicting a V shape. We can't. I mean, there's an oil price war going on. We have US shale industry cannot function below $50 a barrel. This is all connected. It's a whole big economic event on a global scale. And so all the drivers of our economy that were in place before this, globalization, the mispricing of risk. We had 60% of corporate debt the run before junk. It was all like fuel to grow the economy. Globally, all that's gone. So all those multipliers are away. So it's going to be a much more sedate economy coming out of this. So I see people with liquidity problems needing to get out, coming to reality like summer, June, July, August.
So George, do you agree with that? Where do you see this? Me and you were both in the down market, so we went through that foreclosure wave in 2009 and 10.
So do I disagree? You know what? I think the truth is, I think nobody can look into the future. I think it's an opinion, and I'm gonna.
What is your opinion? And not disagree per se. What is your opinion?
Who knows?
So listen, I'm gonna paint a prettier picture, because you know what? I live in a different world. I live in a more optimistic world. I don't tend to look at data as much as I go with my feelings, and that's probably one of my biggest faults. But leading back to my feelings, you know what? Every time I get off the airport and I get off in South Florida, no matter where I travel throughout the world, I tell myself, wow, I'm so happy to be home. And boy, do I get around, and boy, do I travel. And there's no place in the world like Miami and South Florida. And you know what? I think I think, from my international friends and clients, there's probably nothing worse than being trapped in a Corona world in a third world country. I think everyone's going to run into a comfort zone. And I think the foreign nationals that have been in the sidelines for a while are going to say, I'm over it. I'm going to the USA. And what better than South Florida? I think the interest rate is going to fuel that as well. I think with the low interest rates, I think it's going to keep on attracting people. When you look at the last recession, when you look at Miami's bounce back, it was strong. It was faster than any other state, faster than any other country. So you know what? I'm hoping, okay, because of how much I love the city, and I know how awesome this city is from a cultural perspective. Come on, we have J-Lo, we have A-Rod, we got Lil Wayne here. Everybody wants to be here. And I think, I'm optimistically thinking that this is only gonna propel more people to make that push. Anybody who was thinking about it is gonna do it. And I think it's gonna happen in droves, to be honest with you. That's what I'm seeing. Or that's what I'm hoping for, better yet.
I mean, and look at you, George, you're still on your jet during Corona.
No.
On my way back from Monaco, I'm dying to get back to Miami.
Actually, anything you want to add to distressed properties? Anything your opinion?
I mean, it's going to be interesting to see what happens. I think that I'm kind of that mindset that it's so hard to predict where we're going to go, because I feel like every single day it's changed, and so I'm optimistic that, but that's just me being optimistic. I don't know that that's the reality of it. I do think that, we have more money in the houses now than we did in 2008. So hopefully that's going to help a little bit. I think we're not going to end up in the same position, but, I would trust what Anna says over what I say, over my optimism.
Well, listen, don't forget this, that markets are run off emotion anyways, at the end of the day, so.
They are. Look, I love South Florida too. I grew up in New York City. I love it here. I've been here 7 years. I'm generally optimistic. I'm not saying this from a place of non-optimism. I'm just looking at what sort of the aggregate effect of all of this is going to be. Look, we've had low interest rates for years. We've had historically low interest rates, and that has not fueled sales. We've had decreasing sales volume in the face of those low interest rates. It's actually not about that. What fueled the luxury market, talking about that market here, were cash buyers. And going to Miami Beach, which is a good sort of proxy for the luxury market, 100% of the volume loss was the loss of cash buyers. The number of people financing stayed flat. So the low interest rates actually did not fuel the buyers this past cycle. But I'm going to agree that people do have more money in their homes right now. So there is a floor, and we also have an undersupply of price attainable housing. Like we have this duality right now. We have this enormous oversupply of luxury, especially in the condo space. At the same time, we have the highest percentage in the nation of cost burden renters. That's people paying more than 40% gross on rent. So we kind of have this like market divide. And so there is demand in place that hasn't been met at lower price points. Granted, those people are going to be losing their jobs at a higher percentage, so we'll see what they can afford. But look, markets are fueled by emotion, and the overriding emotion we're going to have for a while is people feeling a whole lot less rich across the board. That's what happens in economic downturns, and that affects everyone's purchasing decisions. So
there is a potential for distressed houses to come on the market.
Always. In an economic, I mean, I don't know the future. Always.
Well, we've had a shortage for the last couple of years.
Listen, so, I think anybody, like in all markets that were over leveraged during this time, I think they're going to pay a dear price.
Yep.
I think. Go for it, Anna.
Also, Airbnb is a segment that didn't exist. It wasn't part of the equation in the previous market segment. Airbnb superhosts are in big trouble. This has been in the news a lot lately. You had people taking on leverage, buying multiple Airbnb properties. Those properties were income producing assets. They no longer are. Condos have very high carry costs, taxes, maintenance, all that stuff, and their mortgages because they finance them, and they can't hold. So those people, that's why Airbnb was giving out money, like 25% of cancellations. They're trying to keep it afloat for a little bit, seeing how long all this would last. This is going to last a while. They can't keep it on. They can't keep it afloat. Mm-hmm. So you're going to have super hosts dumping units. That's distress right there. And what happens? They dump units in condos. They reset the line.
Right.
I think also from a commercial perspective, anybody with a retail restaurant portfolio, I think that's over leveraged as well. I think it's going to pay a dear price as well.
Exactly. Yep.
This will be felt from top to bottom.
Now, here's a really good question now that we're on analytics and in the market. So how does this affect rentals? Do you see rental prices going down? Do you see that now landlords, because they can't evict in this time right now? And I'm sure, I mean, as a realtor, I've already had a couple of my renters come back and ask for price decreases. So what do you think about renters?
Prices come down. It's short-term deflationary. If the underlying asset price has come down, which it probably has, the rent will come down too. And the answer is, and again, like if you have a $1,500 rental, that's probably local economy. That person can't pay. There comes a point when you can evict them, whenever that's going to be in the future. I mean, evicting people at scale will back up the court systems forever anyway. But which is also a decrease in property value. If you own a property and you know that you can't evict the tenant because the court system was backed up forever by mass evictions, right? What is your property worth as an income producing property? There's a risk to getting in a new tenant. They could just say, I'm not paying. It might take you a year to evict them. If 25% of the county is unemployed and they're not paying rent, what are you going to do, right? So of course it's downward pressure, and tenant and owners absolutely should work with their tenants, because you don't want a vacancy in this environment at all. So lower rent.
When the market crashed, we saw that in the short term, but after the short term, rental skyrocketed. Less people were able to qualify for loans. There was a huge rental pool. You had an artificial group added to the rental pool, which people that were losing their homes. You still had a healthy rental market, and you had people that were moving in and foreign nationals coming in, and rent just skyrocketed right after that.
Yeah, well, I also add, like, the reason that Miami had that steep incline recovery, we'll call it, coming out of it, was because prices plummeted. That's why people came in at the low prices. That's why we had our prices fell as a percentage more than other markets, which is why we had a steeper recovery. It's a function of price.
Yeah, that makes sense. Chris, we haven't forgot about you, buddy. I'm sorry. We're talking all this analytical stuff, but let's get back to mortgages. We had a question here from somebody. when looking at a mortgage side, if they don't have other collateral, how long is the process to get a loan? I guess, what kind of collateral are they looking for, is somebody's asking. When looking at a mortgage side, if we have other collateral, how long is the process to get a loan? Does that make sense to you? Yeah, can't hear you.
Can you hear me now?
Yes.
Okay, sorry. I don't know what's going on. It keeps switching. So what are we going to do with that other collateral? I need more info on that.
Yeah, so whoever gave this, an anonymous attendee, please give us a little bit more in-depth question. Anything else you want to share with us about mortgages, or anything that we need to know from a lender's perspective, Chris? Because you pretty much answered all of our questions we had here.
As far as mortgages, I've actually seen, an increase in purchase business. I don't necessarily focus on refinance business. I have a partner that I refer my refinance business to. Last month, I closed $4.6 million in purchases. One of them was a very high-end property. So again, going back to what Ashley said, I also see a huge fluctuation in the luxury, the higher end luxury market that I didn't expect. I actually have another contract right now for 1.990 and another one for 1.4, and another client submitting an offer for a 1.425 property. Although these clients aren't tax return clients, these clients are qualifying with bank statements. These clients are not your cookie cutter borrower who want to show you their taxes and pay the IRS. But as far as the regular transactions, the conventionals and FHAs, FHA has had a few overlays when it comes to their credit requirements. Now, that doesn't mean that we can't do under what their overlay is, which is a 640. Okay, we can still go down to 580 for an FHA, although it's going to require that we restrict the debt to income ratio to 49. And we also need 3 months reserves after cash to close in their account. Depending on the situation, I can go into what can be counted as reserves, but I don't really want to go into all of that right now unless somebody wants me to. But on a conventional standpoint, first-time home buyers that qualify can still purchase with 3% down. We're not Chase or Wells Fargo. We don't require you to have a 720% down to purchase on a conventional product. The reason you're seeing those changes being made on those big banks is because they've met their threshold for volume. They need to close what they have in their pipeline before they start accepting any more transactions. As far as my lender, we're still accepting 620 minimum credit scores for conventional purchases. If you're a first-time home buyer, which by definition, a first-time home buyer is anybody who hasn't had ownership interest in a property within at least 3 years. That means you haven't been on a deed or a mortgage or co-signed, okay? And that would be 3% down. If you're an experienced home buyer, you can do 5% down to the conventional, obviously within qualification. But overall, things have been going pretty well on my end. I'm seeing buyers lose jobs, but we find a workaround. We add a family member to the transaction. So I guess that could also be a challenge. It's not necessarily always a straight shot. Going back to what I mentioned, I have a client right now who is actually a bartender at the Intercontinental, and she's been notified just recently that she's not going to be able to go back to work. We're already under contract. We have an appraisal. The file was conditionally approved based on the income that I submitted the file with, but the circumstances have changed. So now we have to go back to the listing agent, and this affects sellers as well. If they're looking to purchase the next property or rent another property after that sale is done. So overall, I'm seeing that impact, but rates are still solid. Buyers are still being qualified, and purchases are still being done. As far as value going down, I don't see how that's going to happen anytime soon, with the fact that these sellers are getting like 4 or 5 offers when they come onto the market. So I have buyers that are pre-approved that can't get their offers accepted, and they're even going 10,000 above asking in some instances. So, I mean, it's hard to tell where it's going to go, but as of right now, working with a mortgage professional who can get through this and find creative outlets is very important, because if you're working with the wrong person, your deal is going to fall apart and your reputation's at risk.
Yeah. So I guess the person's question, they've typed in a little bit. They apparently own their own home free and clear, and they're looking to pull out a mortgage, and they want to know if they can use that as collateral to be able to qualify for a mortgage.
So I think that what this person's asking, and that's a great question, is can we cash out equity from a property that's free and clear based on the value, and then use those proceeds from that cash out to purchase another property? Yes, we can do that. Although it's not always a simple answer. I need to see what kind of debt this person has. I need to see what kind of down payment you're going to be able to put on the next purchase based on the equity that we can cash out on the current property. Also, what's going to happen with that property? Are you going to sell it? Are you going to rent it later? These are all factors that need to be considered when you're cashing out to purchase. Because it could be more favorable for you to just get rid of the property. And by that, I mean sell the property instead of cashing out, having a mortgage on that, and then also obtaining another mortgage. It might be better to just sell that asset, depending on the situation. Always hold on to properties that are free and clear. But if you feel motivated to move, it might be an option to sell instead of cashing out.
Right. So we're answering some questions here. So we have another question here from an attendee called Danny Nix. We service a different market on the West Coast. In saying that, we are finding that real estate properties are becoming a priority. Individuals are looking for more space. Is this something you're seeing in your market as well? Anybody want to answer that?
So you know what, when you're saying more space, I think that goes across what everyone's been saying, that there's been more of an attractiveness from the condo market to the single family home market. People want that separation. They don't want to share space anymore. I think for sure we're seeing that across the board.
I agree. I think we're definitely going to see people coming looking for more space, for more home, for more of a home than they had after all of this. And, and Miami's going to be a good market for that.
Yeah, part of my fantasy recovery plan includes everybody from New York, that's all squished up, coming to Miami to the rescue and financing stuff at low interest rates, taking over beach condos, houses in the Gables.
Yeah.
Servicing our, ordering from our local restaurants.
I love your optimism.
And just
are you sleeping or awake?
What Christopher was saying, a lot of the new homes that have come on the market since this started, like the very, very perfect homes have sold quickly and have sold well. But Christopher, if you have people that need homes, I've got a few that are sitting and ready for your people. So I think that we're really seeing like the perfect homes flying, and really, much more than I would have expected, but a lot of the others are sitting. So I think there's, you can see from the analytics that people are looking, but they're just not transacting yet. So I think there's a lot of people out there, but.
So that actually leads to another good question we have here. And I'll read the question and then I'm going to add to it a little bit. As sellers, we understand we may have to lower our selling price because of the circumstances. What seems to be the average percentage of change seen so far? Just to add a little bit, that's actually, when we as realtors price properties, we look at the market statistics and we look at in the last year, and we base it based on what an appraiser would do. And we have not seen very much price decreases. So if the property is priced to sell and it is in great condition and it's a single family home, it typically is going under contract fairly quickly. Still, in today's market is what I've been seeing. What have you guys been seeing as far as a price decrease or a percentage that people should consider when pricing properties?
So you know what, one thing that it's tough to do is to go back to predict what's going on in the future. As an appraiser, you go back and you tell people what it was worth. As a realtor, we have to look forward and see what the market's gonna absorb. And you know what, that depends really on what market you're in, what product you're in, and the demand for that product. Ashley was saying earlier that, my perfect homes are flying off the shelf. You know what, every price point in every sector has their sort of soft spot, their perfect home, their high demand product. So I think it's a tough question to answer because every market is different, every product is different. but I think you have to get a pulse on the market. I think you have to go out there, and you know, the beauty about real estate is that the market talks to you. If you put your listing out there and nobody calls you, guess what? You overpriced it. You know, if you put your listing out there and people call you, and you're getting appointments and you're getting offers, and you know your offers are getting some action, then you priced it and you market it right. So I think the best answer really is get an awesome realtor that can really get a pulse for the market, take a look at what's been moving, you know, figure out where your house falls into that, and put it out there and be able to react with the market as soon as possible. That's my opinion. Anybody else want to chime in on that?
Yeah, really well said. I agree 1,000,000%. And I like what you said about reacting, because the market does speak. And I think that the dust hasn't really begun to settle. Things change week by week. So it's really important that you observe and react to what's happening. And that's kind of all anyone can fairly say. That's a very broad question. You know, coming into this crisis, we had submarkets, you know, that were disasters, that 140 months inventory, and then we had ones that only had 5 months of inventory, like you know, a single family home market in Pembroke Pines. They fly off the shelf like this at 98% asking price. So that market is not going to behave the same way during this period as would a market that walked into it with over 100 months of inventory. So that's not a question that's possible to answer across the board. It'll depend on the health of your market before. So yeah, just work with someone really good, and then just, yeah, I agree 1,000,000% with Jorge. You test the market and you have to react and monitor it really now more closely than you would have before, because things really are changing by the week.
Yeah, I agree. Anybody else want to add to that? We have another question here, actually for Anna. How about the ultra high-end rental market? How do you see it increasing, decreasing demand, pricing, the ultra high end? And Ashley, you probably can answer this too. So between Anna and Ashley.
Yeah, that's a little bit of a tough question, because when we say ultra, are we at like 20,000, 30,000? Where is that, right? And so that's like saying 10 million plus houses. And all of those transactions are by definition like outlier sales. There's so few of them that they're statistically insignificant, right? Everyone likes to read about them in the newspapers. It's like, you know, lifestyles of the rich and famous. It's the human element story. But in reality, they comprise such like less than 1% of the market that each one of those events is like a special noteworthy event by itself. Having said that, though, many of our outlier sales that hit the press, you know, they hit the press saying, you know, house sold for 16. They don't tell you that it was listed at 30, went through 3 realtors and sat in the market for 2 years, went from 30 to 25 to whatever. And it ends up selling. It's still a headline, like, God bless, they sold it for 18, right? But it took, you know, all that time to get there. So I would say the same logic will hold for the luxury rental market. They're outliers. Look, in any period of time, no matter how bad the economic picture is, there's always somebody with money. There's always somebody who wants to spend a lot of money. In the Great Depression, there were people with money to spend. So if you get that person and you connect with them and they rent or buy your product, like, that's great, that'll happen. So I guess my answer is the ultra high-end leasing or sale market is just, they're all outliers, and they're all individual outlier events. But within that context, listen, especially those people, everyone's taking a hit. You have major funds. You know, the biggest hedge fund in the world was down 20%. You know, Dalio's fund was down a lot. So everyone is feeling a hit across the board. And in my mind, that would affect discretionary spending across the board. But again, these sales are so infrequent that they're outliers.
And I think people are probably thinking this and asking this question, assuming that maybe we're going to get some of the New Yorkers coming down, maybe not wanting to commit to a purchase yet. And so maybe that will drive some of the high-end rentals up. That's, I think, yet to be seen, but that's, I think, where we would be seeing it. If there's people that just are relocating, but maybe not committing to a permanent relocation yet.
Yeah, excellent point. And also, Elena asked, also better to act than to guide. Yeah, so I agree with that. The question of like what percentage discount to give, it's such a broad question across the board. Like if your market was healthy going into this, like the inexpensive single family home market, then there's no crisis there. Like monitor it, there was not a glut inventory. But if you're trying to sell a product in a market segment that was in really bad shape coming into this, like a luxury condo market that had 80, 100 months inventory before Corona, 100% guide. You don't want lead. You don't want to catch a falling knife. So if you're trying to sell product in a market that has, like the article I just did recently, I contribute to today in the Real Deal about Sunny Isles. Like Sunny Isles had 0 sales past $3 million last month, and there are like 200 active listings, like for real. And there were 4 sales past $1 million, and there are 600 active listings. So if you're in a market like that, just price, like undercut everybody and get out. You want to lead, you don't want to catch the falling knife. But if you're at the other extreme, if you're coming into this at a market that was very healthy, like $300,000 single family homes, then no reason to panic, kind of monitor and react as you go.
This has all been great information. Thank you guys so much. I mean, we've gone through all of our questions. So Gina, did you have anything else you want to close? Maybe any other questions or anything you want to say? Thank you for putting this panel together. We really appreciate it.
Well, before I say the closing statement, is there anything, George, that you wanted to share, or?
So you know what? I was just curious on Anna, Ashley, and Christopher's take. If you had some hedge fund money today and you had to invest it today, what sector of the real estate would you put it in? All in. You can't diverse. All in. Blindfolded. Talk to me. Anna, start first.
It has to be like today, like right now?
Yeah, like right now.
Okay. So it is my thesis that we're going to have a period of, the government is printing enormous amounts of money, and we're going to have unemployment going on for a while. And I think we're going to have a period like we had emerging from the Depression, like the New Deal, where, going back to earlier, like how much is your asset worth if no one is paying rent, right? So if I had to spend right now, because I think it's too early to buy real distress right now, today I would buy government housing, because the government always pays. And I think that's a long-term trend coming out of this, is people with high unemployment, but the government is going to keep paying. So if you're concerned about income, I would, if I had to do it today, it would be government housing.
Ashley.
I mean, I think I'm going to follow Anna, because honestly, I don't want to buy today. I want to buy in 6 months. I really want to see what, how this shakes out and what comes down. But I would say, I wouldn't have said the government, but I like that. That's a perfect, I'm going to follow her if I have to buy right now. But I think the lower end, where people are going to still be able to afford. I mean, if the high end is transacting, but I mean, but the real safe, I think, is going to be the lower, because we're still going to have people that live here and buy here. And if they can afford, and for me, Coral Gables low end, I mean, if you can be in $500,000, that's a really, that's 1 in a million. So I think that I'd be in that market.
Christopher, talk to me.
So as far as hedge fund money related directly to real estate, I wouldn't invest it in anything. I would keep the liquidity and wait this out.
You said you have to today.
We're not allowed to do that.
You have to today. That's the question.
Yeah. You got to follow the rules just this one time.
Have to.
Then I would have to short retail spaces and commercial spaces like malls, restaurants, major outlets like Disney World. All of these places are going to lose so much business. So I would bet against them right now.
Man, you are no fun, Christopher, whatsoever. Thank you for.
I'm a mortgage broker.
so listen. If I had some hedge fund money, I would go condo. I would go low end entry level condo, and the reason why, I think that with this government, getting very involved, I think they're going to fuel the financeability of those condos that were locked with a 20% down. And I think it's going to fuel those renters that are stuck, that can't afford a single family house, but can afford their first apartment. And I think when lending goes 20 to 3 or 5% down in that entry level, I think it's going to create a big, opportunity for a lot of people that are renting and cause some money to spike up. And again, that's just me and my fantasy world. I want to thank Gina for the invitation, Rebecca for the awesome hosting, and all the panelists for joining me today.
Well, great. Well,
thank you guys.
Before I say a few things, is there another question there, Rebecca?
No, I think we've answered them all.
So I just want to say,
I'm in quarantine. I can talk for hours. I'm
I know you can.
sorry.
So, let me go ahead and close this then for us, George. You guys have been amazing. Rebecca, we couldn't have done this without you. You're fabulous. And thank you for partnering with Miami Real Producers on this. Anna, I found her on Facebook. If any of you want to follow her, she's amazing. I learned so much about real estate and just the trending market. You're brilliant. Thank you for all everything you shared. I'm a big fan, you know that. And George, thanks for being a great leader and helping me and introducing me to Rebecca. It's been amazing. Ashley, you're one of the first realtors that I approached when I came into the market in Miami and started Miami Real Producers. And thank you for opening your door to me. I appreciate it. And definitely one of the most amazing top producers I've met so far. And Christopher is one of our partners at Miami Real Producers. And so excited to have you, Christopher. And thank you for being here with us today.
Of course. Thank you for having me.
Yeah. So thanks, everybody. You're going to hear more from me. And I appreciate everyone taking the time and doing this today.
Thank you, everyone.
Thank you, guys.
Thank you, guys. Have a wonderful afternoon.
Likewise.
Thanks,
Bye.
awesome.